The investment team here at Oak Harvest has been discussing the likely V-bottom in stocks since mid to late April, while many others, including numerous retired hedge fund billionaires, were touting lower lows, crashes, or retests. We discussed this for weeks in our videos. Looking back, April 7th was what we thought was the low for the overall S&P 500 index and for US stocks, most likely for the rest of 2025, x the unforecastable black swan event. The minus 20% bear market correction was largely event-induced by President Trump's unforeseen tariff policies, x the great financial crisis in 2007-8 and the popping of the speculative dot-com bubble frenzy in 2000-2001, which did precede longer and deeper recessions. History said enough damage had been done, and we would likely V-bottom in a similar fashion as the V-bottoms in the last 20 to 30 years. And investors, the really good news here, this V-bottom happened without the Federal Reserve intervention and interest rates being cut. More Fed rate cuts are in front of us. Think of that, investors. We're at marginal new all-time highs in stocks, and the Fed is paused. The Zweig broad thrust on April 24th created the first of what many chartists call a bullish island reversal. I read at least 10 articles poo-pooing this data set at the time. This is why one of our follow-on videos titled was V-bottoms, no one gets in. One can rationalize why markets have V-bottomed since early April on walking back of tariff extremism, better jobs, and wage inflation data, but viewers who know me know I like real-time market data. The bond market data since early April was saying real growth was okay, and inflation peaked in early April, not the stagflationary doom-biased calls that many others were suggesting. For months, we've discussed how the charts in the economy look very similar to the period that was mid.com, not peak.com. The period into October 1998 bear market sell-off was caused by the event of hedge fund long-term capital blowing up. I haven't been able to find many who believe this analogy or will spend any time researching it. I'll update a few of the chart overlays like the S&P 500 and the SOX Semiconductor Index and a couple of others later in this video, but look at this data set before you dismiss my thoughts. According to Tyler Lovingood of Potomac Research, on average, it's taken 512 trading days for stocks to reach new all-time highs following a minus 20% decline when using closing prices. Look at this data set. Look closely. It took us only 57 days to regain new all-time highs during this V-bottom. Next shortest time period, yes, investors, late third quarter, early fourth quarter, 1998, mid.com infrastructure build-out. Back then, it took 59 days, only 2 more. No other V-bottoms come close, not the COVID-induced government stimulus windfall in 2020, not the earnings recession bear market in 2022. Here's an update of the S&P 500 overlaid back then and now. The pattern remains bullish, and yes, historically, July is one of the better returning months for the S&P 500 with earnings and buybacks around the corner. Up and to the right is good. New all-time highs are not bearish historically. That said, after rallying for almost 3 months off the April lows, do not expect the pace and percentage gains of stocks to continue at this rate. Expect the pace to slow. What groups might slow? Well, technology names that have led the rally usually slow their gains in the third quarter. I would expect the same this year, with semis likely stalling and maybe software and healthcare taking up the lead. Here's the overlay of the SOX Semiconductor Index in 1998 and now, updated. We called for a semiconductor rally while many others were hunkered down in April and May, calling for lower stocks and risk off. We got our rally. We don't expect a broad semi sell-off in the second quarter, but do expect a 2 to 4 month sideways consolidation after second quarter earnings per share are reported in August. This would be the AI pause that refreshes. We got this similar dynamic playing out in late 1998 and 99. Maybe the next stage higher on semis requires a China-US trade agreement, or maybe it's just to digest inventory. History says we are likely only about 1/3 done with an 18 to 24 month semiconductor rally. Investors, we would expect a normal late summer pullback in the markets, but investors, you most likely won't see those low levels of April again for quite some time, if at all this year. Many institutions got too bearish near the April lows and de-risked, and are already way behind performance curve in the second quarter. If this continues to play out as we expect, our team has stuck with our 2025 year-end target of about 6,600, even as stocks sold off into April, and most strategists slashed their targets from over this number to the low 5,000s and are now raising them once again. Does this mean that you shouldn't add to stocks, particularly if you're younger and in saving and accumulation mode? No. Why? Because rarely can you pick the absolute level in both price and time on both the buy side, the sell side, and the buy side once again, particularly in growth stocks, as we've covered in prior videos. New all-time highs are not bearish. Investors, regardless on the path for the economy and the financial markets in the next few months, the investment team at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend and a great and safe 4th of July, and know that the Oak Harvest team is doing what we can to plan for you and your family's future, regardless of what stage you're at, into or out of your retirement.